This study shows how your income changes once you retire. Oh man, we're just going to go right to the chase. We got my man Peter Brady and Stephen Bassale. So Stephen Bassale and Peter Brady. Remember the Brady Bunch episode where Peter Brady got the measles? Yikes. Remember they quarantined him? And, Carol and Michael and Alice, they said, stay. What did they put him? They put him downstairs like Andrew Cuomo. Remember that? And Jan was all, oh my goodness, wrong. And blah, blah, blah. Remember that? Look up the Brady Bunch episode, Brady Bunch measles on YouTube. You'll get a kick out of that because it's funny. So this from the Dateline May 2023 from the ICI, Investment Company Institute, which is basically the trade group for mutual funds, ETFs, whatnot. When I'm 64 or thereabouts, changes in income from middle to old age, and I'm just going to cut to the chase. We find that the typical individual maintained more than 90% of their spendable age 55 to 59 income. Spendable income is income you have after taxes. So the income you have after taxes, we find the typical individual maintained 90% of their spendable income, the income that they had when they're 55 and 59, through age 72. 55 to 59 is generally your most earning career time. And yet the typical individual maintained 90% of their spendable income even when they're 72 years old. And again, spendable income. The income available to spend after paying taxes and saving for retirement. What they do, they use administrative data. They're using literally tax data. And they're following a cohort from the year 2000 to the year 2017. They're saying they're 55 now, they're 72 later. They actually look at individual tax returns. They don't identify like scandalous tax return, but they look at individual tax returns. Let's just keep going. This study used admin tax data to answer two questions about retirement in America. First, how does spendable income change as workers transition into retirement? Again, spendable income, the income available to spend after paying taxes and saving for retirement. All right, so how does spendable income change once a worker transitions to retirement? Second, how does the composition of income change during this transition as workers move from relying primarily on earnings to relying primarily on Social Security benefit and retirement plan distributions and other income? The belief that the U.S. retirement system produces inadequate retirement resources based largely on research projecting that most Americans will not accumulate enough resources for retirement. They talk about this Van der Heij study, which I've destroyed. They talk about the Alicia Manel study, which I've destroyed. And then they talk about right here, Social Security Administration right here. And too few retirees receive income from employer-sponsored plans. That's right here. The belief that employer plans and IRAs are not doing enough to help workers prepare for retirement is based largely on analysis that says too few retirees receive enough income from employer-sponsored plans. And we even quote the SSA from 2016, and the SSA has kind of retracted that, Social Security Administration. And they talk about down here, I'm not going to get too deep in that, but they don't talk about specifically about that article, but they talk about the two gents over at the Social Security Administration, Mitchell and B. They said, yeah, we're undercounting income in retirement at the Social Security Administration. They've been doing that now for freaking decades. It's crazy. All right, let's keep going. We follow a cohort of individuals through the transition into retirement and analyze changes in the amount and composition of their income. Specifically, we begin with a representative sample of people 55 years old in the year 2000 and follow all the way through. We follow all who survived through until 2017. Remember what happened in the aughts. 2000 to 2010 was a bad decade, and yet we're still following those people. And yet the answer that still comes to my mind, we find that the typical income individual maintained more than 90% of their spendable income from when they're in their 50s, which is when they're making the most money possible. Our panel sample includes well over 100,000 households. 100,000. In addition, unlike household survey data, attrition from the sample is not an issue. Why? Because individuals remain in our panel regardless of whether they filed tax return or not. Crazy. Here's where the rubber hits the road. We find that the typical individual maintained more than 90% of their age 55 to 59 spendable income through age 72, with 20% having over 125% of their spendable income from what they did when they're 55 through 59. And 25% having 67% or less. Non-Social Security retirement. So if you think about it, that means 75% of the population had over 90%. I don't know if I can say 75, but a large majority of the population had over 90% of their spendable income. Isn't that crazy? That they had when they're 55 to 59. What would I say? The typical, I don't know if I'd say, yeah, I don't know, but it's a large amount of people had more than 90% when they're 72 of their pre-retirement spendable income when they're making the biggest bucks they had as an employee. Non-Social Security retirement income, that is distributions from IRAs, employer-sponsored defined benefit and defined contribution plans and annuities, was much more common than reported in household surveys. At age 72, 75% of the 100,000 people that they surveyed, the panel, received retirement income either directly or through a spouse with a median amount of $15,000 per individual. Median. Half the people have more, half the people have less. And that's at 72. Hard to say you're going bankrupt. Despite the fact that the lower income workers claimed Social Security earlier, were less likely to work after age of 72, and got a higher share of their income from Social Security at 72, they typically replaced a higher share of their 55 to 59 spendable income. At age 72, the median spendable income replacement rate was greater than 100% for the bottom 25%. You hear me what I'm saying? So all these people, oh, the poor, they can't afford an IRA, blah, 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 blah. Their median spendable income was less than, when they're 72 years old, was greater than 100% of their spendable income when they were 55 to 59 and still working. And the answer to that is simple, because their taxes are way, way lower. It's just, and we're going to show you that here in just a second. This is interesting. We derive our total income from the tax data, but it differs from the tax code's definition of income because we are primarily focused on measuring ability to spend money. As such, we include some types of income that are excluded from taxable income, such as tax-exempt interest and the non-taxable portion of your Social Security. To the extent possible, we exclude from income all retirement plan contributions and include in income all retirement plan distributions. So we're not including as income money going into the retirement plan, but we're including as income money coming out of the retirement plan, which should. Regardless of their tax treatment, which also means Roth distributions as well. It also means we include income not only from taxable non-Roth distributions, but also Roth distributions and the portion of non-Roth distributions that represent basis. So basically, we're taking distributions from all IRAs, 401ks, and all that stuff, and counting them as income, regardless of their tax status now. That's the way it is. The one thing they don't do, though, which is interesting to me, check this out. Our income does not measure public assistance because benefit payments from such programs as temporary assistance needed families, SSI, and Veterans Affairs are not reported to the IRS, neither on tax returns or on information returns. So VA benefits are not even included in this. TANF is not included in this. SSI is not included in this. Well, that tells you it's going to be even better than what they're showing. But check this out too. Real quick, all dollar amounts in this paper are adjusted for inflation and reported in constant 2017 dollars. Median per capita, that means per head, not household, per capita, total federal taxes fell by $6,100 from a bit more than $7,100 at age 55 to a bit less than $1,100 at age 72. As a result, median per capita spending fell only by $3,400 from just under $37,000 at age 55 to $33,000 at age 72. The median total federal tax rate fell substantially, with the typical individual paying much lower income taxes and paying no payroll taxes. As a percentage of total income, median federal income tax rates fell from 10.5% at age 55 to 2.1% at age 72. Are you hearing that? As a percentage of total income, essentially your effective tax rate. Median payroll taxes declined from 6.6 to 0 by the age of 68. Your taxes are falling off like crazy. You have a payroll tax, and why else income tax fall? Income taxes typically decline relative to income because total income generally declines with age. And only a portion of your Social Security benefit are even subject to taxation. We should keep going. Although the replacement rates measures used in the study are based on those developed by Brady, Peter Brady, measles guy, the measures used in the study likely understate the true replacement of spendable income. Why? Because the data do not allow us to measure all taxes and all savings. Our spendable income measure accounts for federal income and payroll taxes, but state income taxes are likely to decline as a share of total income in retirement. In fact, many states don't even tax your retirement income. Look at Pennsylvania, Illinois, New Jersey, Maryland in some regard. There's a bunch of, I mean, hell, a lot of the southern states, they hardly tax anything of your retirement income. Let's see. Our total spendable income measures account for savings accomplished through IRAs and employer-sponsored plans, but they do not account for other savings. Accounting for other savings would reduce pre-retirement spending income to the extent that non-retirement plan assets were drawn down in retirement and boost spendable income in retirement. So what does that mean? When I sell my house, let's just say I sell it for $1 million. Let's just say I buy another house for $500,000. I'm gonna have $500,000 sitting in cash. That is not, other than income tax of the interest I have to pay off that. That is the distribution from that. The tax that doesn't show up in my 1040. There's no 5498, nothing like that I got to file with the IRS in terms of these guys don't know how much I had in my savings account. They don't know how much I have it before. They don't know how much I have it left. All they know is how much interest I received off that savings account. They don't know if I pulled 50,000 out. They don't know if I pulled 100,000 out. They don't know if I pulled anything out. That is spendable income, though. It's spendable income. It's sitting in this freaking pocket of money over here. Drawing interest I got to pay tax on, which shows in the 1040, I grant you. But taking the principal out, how did they figure that out? They can't. Because there's no form that says what I have at the bank. In terms of, like, unlike an IRA or 401k. There are forms that say, hey, you have $52,000 in IRA, Josh, that the IRS gets. It doesn't happen in a bank account. It doesn't say your account balance was $500,000. Now your account balance is $470,000. Thus, we assume a 30% distribution, a $30,000 distribution. It doesn't show that. To the extent that non-retirement plan assets were drawn down in retirement, that boost spendable income in retirement, but it's not reflected here. And you can say this study likely understates the true replacement of spendable income. Yeah, that's probably much all I want to talk about. Yeah, the typical, these guys are spot on here. The assumption that retirees would want to replace 100% of their pre-retirement spendable income is a reasonable starting point. But the reason is the optimal replacement rate would be lower than 100%. For example, there are certain work-related expenses to commuting, purchase of lunch and coffee, buying work clothes that need not be incurred when an individual no longer works. But perhaps more importantly, if workers raise children prior to retirement, necessary expenses presumably be lower if these individuals or couples are no longer supporting minor children in retirement. Just 100%. Yeah, there's more in this. I want to just see real quick. I thought this is pretty interesting. The share of the population who derive a portion of their income from labor declined markedly from 90% at the age of 55 to 34% at 72. But check this out. By age 72, only 23% of the population had their own labor income. So while 34% derived a portion of their income from labor, about a third of that was because essentially the husband's working and the wife is not. So they're still driving, the household is still driving a portion of their income from the labor of the husband, or vice versa, whatever. But for individuals actually working, less than a quarter are still working at the age of 72. Adjusted for inflation, median own labor income fell by about 2/3, from $44,000 to age 55, at age 55 to $14,000 at age 72. With more than half the decline occurring between the ages of 61 and 67, which tells me people are going to work part-time. The share of the population who received their own retirement income increased from 17% at 55 to 67% at 72. Just putting on the kibosh that no one has access to retirement accounts. It's so stupid. By age 72, median own retirement income was $16,200 and median per capita income was $15,300. So the retirement income, the median by the age of 72 was $16,000. People aren't running out of money. Now, could you say, hey, they could run out of money at 85? Okay. Well, how many people survive to that? By age 72, only 16% of 72 years old only had their income as Social Security. That's it. 1 in 8. Anyway, such a good article. And I can't quote it or link it because I got on this PDF file, but I'll post this guy right here and you guys can look it up yourself. Again, dude, come on. The evidence is overwhelming that the vast majority of retirees are doing just fine. Again, You can sit there all you want, look at the Center for Retirement Research National Retirement Risk Index, and I've just destroyed that. It's just, look, I'm not saying they're silly people, but that whole perspective is silly how they frame that. I'm like, this is insanity, man. And of course, it got a lot of street cred because media loves reporting on negative stuff. Crazy. But the real data is, it's kind of like, America is so violent. You stay away from South Fulton County. You stay away from Chicago. You know what I'm saying? You're just not going to be a criminal. I mean, yes, there are a few people. The vast, vast, vast majority of people in America are not going to be subject to criminal activity. They're just not. It's the same kind of thing. But what gets going around is, oh my, like there's some guy just posted today on some, chat thing or whatever it's called, not bulletin board, on advisor perspectives on the comment section. And my man Bert, I call him Red Bert. He said, don't you know, Josh, that someone fled El Salvador because a mayor got killed, and so El Salvador is so violent. And I said, well, that's weird because El Salvador, the vast majority of young people are quite happy in El Salvador. They, according to the Gallup study. So if all these people are fleeing because it's so violent, yet El Salvador is they're 4 times happier, they're young people, than we are in the United States. So if all those people are fleeing the violence, then how do you explain that? How do you square that circle there, Lefty, Red Bird? You can't. And just because some guy got killed doesn't mean the whole country's falling apart. I mean, is there more violence in El Salvador per capita? Sure. Are you likely to get killed in El Salvador? No. How do we know that? Because we're talking one person and whatever it is. I don't know what the data is. 100,000 people, something. I don't know. That means 999, whatever that is, 1,000 people aren't dying. Anyway. All right, love your thoughts. This is good stuff. And don't forget my investment courses in the doobie-dook. I got to keep promoting on the front end because usually most people don't stay through the end. So if you stayed through the end, you are a legend. But if you haven't bought my investment course yet, it's in the doobie-dook. And again, it's a 30-day free look period. All right, God bless. We'll see you.